What was Warren Buffett doing at 19 years old? He was reading this book. He claims that it had changed his whole life. Let's check that out. Speculator versus investor. Before starting investing, you should understand the difference between those. Speculator gambles that a stock will go up in price because somebody else will pay even more. But like all kinds of gambling, the house always prevails. If you don't have a statistical edge, you can't beat the house for a long time. Majority of speculators make their brokers richer, not themselves. Investor, on the other hand, calculates what a stock is worth based on the value its business is. Investing is a unique kind of casino where you cannot lose in the end if you have the discipline. Stock prices, aka Mr. Market's mood, swing between unsustainable optimism and unjustified pessimism. Prices often diverge from the true value of the companies. An intelligent investor looks for that kind of discrepancy. He or she searches for value, never pursues extraordinary results. Serious investors do not believe that day-to-day or even month-to-month fluctuations make them richer or poorer. They never feel forced to sell their shares just because Mr. Market says so. Inflation. Before starting investing, you should also understand the purchasing power of the money. Think about yourself. You fight tooth and nail to earn money and try to save those in a savings account. Then years pass by and you look at your account balance. Now your savings seem to be able to buy less goods than the initial. This silent killer is called inflation.
Americans are getting stronger. 20 years ago, it took 2 people to carry $10 worth of groceries. Today, a 5-year-old can do it.
𝙏𝙤𝙢𝙤𝙪'𝙙. Investing is usually perceived as risky, but the real risk is getting poorer as a result of the shrinkage in the purchasing power of the money. Interest-bearing instruments like bonds, deposits, usually don't offer much return over inflation. That's why investing in stocks is considered as one of the best protections against inflation. A properly selected stock can present dividends plus some capital appreciation through decades. Passive investor versus active investor. If you have decided that you want to be an investor, let's look at the different types of investors first. 1. Active, enterprising investor. Continually researches, selects, and monitors a dynamic mix of stocks, bonds, and mutual funds. 2. Passive, defensive investor. Creates a permanent portfolio that runs on autopilot and requires no further effort. What should passive, defensive investor do? As a guiding rule, you can start with a portfolio of 50% stocks and 50% bonds or other interest-bearing instruments. If stocks appreciate in value and their allocation goes above 50%, you can sell stocks and buy bonds and bring back the allocation to 50-50. This is called rebalancing. Initial allocation can change according to the risk appetite or capability. The portion for stocks can be decreased to 25% for a risk-averse person. It can go up to 75% for a risk-tolerant person. Stock selection for passive investor. Now comes the fun part, stock selection process. Actually, it's straightforward for a passive investor. Here are the rules. 1. Diversify. Have a portfolio of 10 to 30 stocks and try to select from different industries. 2. Large companies. Select companies that are bigger. In today's terms, the companies should have revenues over $1 billion. 3. Conservative financing. Choose companies that use conventional financing, not the ones with excessive mumbo-jumbo. Current assets should be twice the size of the current liabilities. 4. Dividend history. Select the companies that have a long history of uninterrupted dividend payments, like at least 20 years. 5. No earnings deficit. Choose the companies with no loss in the last 10 years. 6. Earnings growth. Select the companies that have increased their earnings annually by at least 3% in the past 10 years. 7. Cheapness relative to assets. Current share price should not be more than 1.5 times the book value per share. The book value is the accounting value of the equity, which is the difference between the assets and the liabilities. However, it's harder to find that kind of company in today's world, since book value doesn't incorporate intangible assets like franchises, brands, patents, trademarks, goodwill. 50 years ago, intangible assets were far less important than what they are today. 8. Cheapness relative to earnings. Current share price also should not exceed 15 times of the earnings per share. Earnings should be calculated as the average of the last 3 years. Some people use estimations of future earnings in those calculations, but those future estimations are most of the time wrong by a wide margin. Therefore, the last 3 years will be better suited. Index funds. You don't have the time or the energy for stock picking? That's totally okay. Then just find yourself an index to track. There are almost infinite options here. It can be the big indices like S&P 500 or other specific indices like industry indices, country, region indices. After choosing the index, select an index fund that tracks your benchmark. Try to choose the ones with low fees and also having relatively larger assets under management. Dollar cost averaging. You have selected your stocks or index funds, but now you fear buying at the wrong time? Nobody can have perfect market timing, even Warren Buffett. Sorry for that.
If you realize how much you are not in control, you will be much more in control.
𝙤𝙤𝙢𝙤. Here is the best and easiest solution, dollar cost averaging. You can invest small amounts each month rather than investing lump sum. This way, you will decrease the anxiety of purchasing when the markets are peaking. Monthly amounts might seem small, but don't worry, the cumulative result will be impressive after 20 or more years. What should active, enterprising investor do? Vast majority of people learn after they lose money on stock picking or market timing. Luckiest ones discover this early on, while the less fortunate take years to earn it. Research shows that even the investment professionals do a poor job on those subjects. So, as an amateur, do you really believe that you will do better? Let's acknowledge the truth. You have no chance to make good investments without doing any homework.
We go to Starbucks every day, so I buy Starbucks stock.
Barbara Streisand.
No, God! No, God, please, no! No!
Please, don't do this. No matter how much you love those tall skinny lattes, you still have to analyze Starbucks' financial statements and make sure the stock isn't even more overpriced than its coffee. If you still want to be an active investor, you should know this. Successful active investors are disciplined and consistent. They refuse to change their approach even when it's not fashionable. They think a great deal about what they do and how to do it, but they pay very little attention to what the market is doing. Stock selection for active investor. 1. Diversify. There can be some level of diversification, but doesn't have to be as high as defensive investor. 2. Large companies. If you're an active investor, you don't need to look for big companies. 3. Conservative financing. Current assets of 1.5 times the size of the current liabilities is okay. 4. Dividend history. The company should at least have paid some dividends in the last years. 5. No earnings deficit. Choose the companies with no loss in the last 5 years. 6. Earnings growth. Select the companies that have increased their earnings in the past 5 years in total. 7. Cheapness relative to assets. Current share price should not be more than 1.2 times the net tangible assets per share. 8. Cheapness relative to earnings. You don't need to limit yourself with a price to earnings ratio. It depends on your analysis and aggressiveness. Growth stocks usually have big price to earnings ratios. Important thing here is the expectations and potential regarding future earnings of the company. You can stop the video here and examine the differences between criteria of active and passive investors for stock selection. Beginner tips for active investors. Once you have your plan in place, you can experiment around those edges with your own stock choices. You can keep 90% of your stock money in an index fund and leave 10% for picking your own stocks. Also, you can search which leading professional fund managers own the same stocks that you have selected. If available, go to their websites and examine their most recent reports. By reading their commentary, you may get ideas on how to improve your own approach. Always include a margin of safety in your valuations. It's always better to be safe than sorry. For instance, if you expect 10% earnings growth in the next 10 years, just assume only 5% growth in your calculations. Also, take brokerage costs into account and try not to overtrade. Conclusion. Never ever forget this. The whole point of investing is not to earn more money than the average, but to earn enough to meet your own needs. The best way to measure your success is not by whether you are beating the market, but by whether you have a financial plan and the discipline to achieve it. In the end, what matters is not crossing the finish line before anybody else, but just making sure that you do cross it.
The happiness of those who want to be popular depends on others. The happiness of those who seek pleasure fluctuates with moods outside their control. But the happiness of the wise grows out of their own free acts. Marcus Aurelius.